everything you need to know about director's loan accounts. So a director's loan account is essentially an account which you give or receive money to the company and it isn't taken through PAYE or dividend or expense repayment. It is essentially the sort of monetary link between the director and the company. So normally when you take any money out, that would be a director's loan, and then if you haven't got enough salary to offset each month, then you'll have a dividend throughout the year. If you don't have enough dividend at the end of the year, then you'll be overdrawn. But if you do, or you've given money in, then you'll be in credit. If you're in credit, you can take the money out of the business and you don't need to declare any income. If you're overdrawn, you'll either have to pay that back or you'll need some extra income to offset that. So when you're overdrawn, you've got 9 months to repay it back. So you've got 9 months and 1 day, which is also the amount of time the corporation tax payment is due from the year end. Essentially, you can be overdrawn and it's okay. And if your balance within 9 months is rectified, it's back in credit, then there is no extra charge. But say you are overdrawn at year end and you haven't repaid it back within 9 months and 1 day, you'll have what's called a Section 455 charge. A charge where it's been classed as disguised remuneration because you basically taken money out of the business, but you haven't essentially put it on your personal tax return because you haven't declared it through salary or dividend. So the company has to pay a Section 455 charge, and it's at a rate of 33.75%. The company will pay that, and then eventually when the loan is repaid, the company will then get that back 9 months after the year end that the loan has been repaid.
So with it, so like what are the typical situations where people would end up taking more than there is money available?
Yeah, how much can you take out?
Yeah, so you can only take out the amount of salary and dividend available. So essentially, if the company has got corporation tax at year end, if it's got extra creditors and you've taken that money out yourself and then the company can't afford to pay its creditors, you'll essentially be in debit, you'll be overdrawn. So you can only, this is why it's really important to take care of your books, because if you don't constantly look at your books and your finances, it's really easy to get in a situation where you're overdrawn. At the end of the day, it's better to sort of make sure you're looking at your books as much as possible, seeing how much income the business has, seeing the overall sort of financial picture of the business. Often it's better for the business to have the cash, especially if it's just starting. It thrives with it, you know, cash is king, it needs the cash. So often it's better to have a direct loan in credit, and then later on when the business is maturing, that you can start to take your loan back. If you come to year end and your director's loan account is over 10,000, you'll have a benefit in kind. So essentially, because you've taken so much disguised remuneration according to HMRC, there'll be a benefit in kind charge, and this will be on the director personally, and it will also be on the business. So it's quite important to make sure you're looking at your records and make sure you're not over that 10,000. At the same time, the company has to charge the director interest, and that's at the HMRC ORI rate, which is 2.25% at the moment, but it will likely change at points. It does change a fair amount. And if interest has been charged less than that, or not even at all, and the direct loan account is over 10,000, there will also be a benefit in kind for the interest that's not been charged. So that's always something that's got to be looked at as well.
So can you take out a loan and then take out another one straight away?
So bed and breakfasting is kind of, it's looking at if you're overdrawn, and then let's say you're overdrawn on 31st December, your year end, and then you've got 9 months to repay it, and then you've earned some income the following year, so you do an interim dividend at, let's say, May the following year, so you've paid it off in May. Technically, you're using next year's profits, and then on top of that, you're then overdrawn at the end of next year. It's bed and breakfasting is basically, you've repaid it, so you don't have to do a Section 455, and then you're still overdrawn at the end of the year anyway. So you're not allowed to just do these interim dividends or pay back the loan for 1 day and then take it back, and then you're still overdrawn, and it makes no material difference. So if you are repaying it, it's got to be material, it's got to actually be paid back, and it's got to be stayed in the company, and it can't just be in, out.
Is there like a threshold through which it has to be paid back and then you stay in the black form?
Yeah, so HMRC will look at it. They don't really like you being over, the larger companies, if you are overdrawn at any point, then you have 9 points from that point. But often with the small business, they're only looking once a year. So, I mean, you've got 9 months from year end is kind of the main rule, which ties in with the corporation tax payment date as well.
Does it impact where there's like two directors in a business who are equal shareholders, for example?
It does, yeah. So you'll have two director loans. It depends if the two directors are close, basically if they're connected to each other, if like they're a connected party. If not, then you'll have two separate loans. If they are, then they'll just count as the one. So, I mean, say it's like a family business and you've just got one director being the father, but then, you know, the wife has been paying in or the daughter's been paying in or whoever, that will just go against his loan because he's connected to that. But if it's two unconnected people, there'll have to be two loans. And you'll get to a situation where it could potentially you'll have one person that's overdrawn and not, and there'll still have to be a Section 455 for that one person that's overdrawn. So it is always really important, again, to make sure you check your records. It's just really important to just stay on top of it all the time.